Welcome back, my friends. As you may have noticed, we are seeing many experts making many assessments and predictions about the economy. Speculative investments are having a disastrous year. Cryptocurrency companies are going bankrupt. FTX declared bankruptcy just this past Friday. Risk assets have been losing value at least since January. The benchmark S&P 500 is down almost 20% this year. Many stocks, tech and real estate-related stocks, are down anywhere from 30% to 97%. A wave of layoffs is sweeping the United States. The layoffs are more concentrated in technology companies, but retail and shipping are not immune. Many real estate YouTubers are saying all sorts of things about the housing market. House prices are definitely going down. And overall real estate sales are declining each month. As we all know, inflation continues to rage in many countries. And the Federal Reserve is aggressively raising interest rates. That is raising the cost of borrowing. And many big purchases rely on borrowing. So, business for house and car purchases is in decline. There seems to be some debate about what is really going on. Is this just a correction or is it a collapse? Or, is it a slow-motion train wreck in which prices keep slowly trending downward for a long time? Home builder confidence is collapsing. Zillow, Redfin, and Opendoor and other iBuyers are selling off their real estate portfolios as fast as they can. Prospective buyers are backing away from the market because they think prices have a lot further to fall. What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Back in June, JPMorgan CEO Jamie Dimon warned about a coming economic hurricane. That it may be less intense than Dimon originally feared, according to a new report from JPMorgan Chase. We see the U.S. in a mild recession in the second half 2023, said JPMorgan economists Michael Feroli and Daniel Silver. The Federal Reserve has been aggressively raising interest rates to tame inflation. And it is expected to complete its rate-raising mission to conquer inflation. We're effectively looking for a Category 1 economic hurricane, the Feroli and Silver wrote. What are the risks? Weakness could build on itself, requiring a larger response by the Fed to get the economy back on track, Feroli and Silver added. The note from Feroli and Silver comes following a better-than-expected Consumer Price Index, CPI, report. The CPI report said there are signs of prices are beginning to moderate. And persistently high inflation seems to be moderating. The report by Feroli and Silver seemed to cause a rally on Wall Street. Investors somehow expected that positive inflation news would cause the Federal Reserve to rethink its course. But Federal Reserve leaders doubled down on their position that more interest rate hikes would be needed. Feroli and Silver are predicting that the Federal Reserve will continuing to tighten monetary supply. And, that the tightening will continue well into 2023 before pausing. Feroli and Silver say that they expect that Federal Reserve will raise the federal funds rate by another 100 basis points overall. They are predicting a 50 basis point increase in December. And they are also predicting 2 additional 25 basis point increases in February and March. That would result in a federal funds rate near 5% by May. Many economists think that amount of financial tightening would push the U.S. economy into recession. But at the same time, the U.S. economy has stayed somewhat resilient. Job growth has stayed fairly durable despite the fast rising interest rates. And consumers continue to spend money. But consumers are now focusing on needs versus discretionary items. Feroli and Silver expect the tight job market to deteriorate heading into the end of the year. Keep in mind that even in a mild recession scenario would weaken the job market. And, in that case, the U.S. would shed over 1 million jobs by the middle of 2024. There are already signs that firms' appetite to hire is easing, and we expect that to continue next year to the point where we see outright declines in the monthly job figures in 2H23, Feroli and Silver said. Markets are now rewarding companies that prioritize cutting costs, and labor costs are often the largest cost category, they added. Federal Reserve Chairman Jerome Powell said that declining job growth is required to bring down inflation. But that is what it takes to recalibrate the economy after several years of pandemic-related disruptions. Whatever the eventual peak in rates might be, Fed officials lately have been stressing that equally important is how long rates remain in that restrictive setting, Feroli and Silver explained. But even taking them at their word, we do think there will be enough evidence of a lasting disinflation that we project easing in 2024, Feroli and Silver added. As far as these economists are concerned, the U.S. economy will enter a recession later next year. And that will cause job losses. Feroli and Silver predict that the Federal Reserve will start to decrease interest rates 50 basis points per quarter starting in 2Q24. And that the federal funds rate will be at 3.5% by the end of 2024. But, Feroli and Silver say that this type of a recession would not necessarily be as destructive as past recessions. Investors and CEOs have been preparing for a recession since the Fed started hiking rates. If we do have a downturn next year, it will be the most well-telegraphed recession in modern memory, Feroli and Silver wrote. That fact alone should change the nature of the slowdown, they added. Some say the painful end of get-rich-quick thinking may be good for the economy. Speculators hoping to make a killing as cryptocurrencies got slammed this year. Cryptocurrency values briefly rebounded from this year's plunge in valuations. But, then one of the most trusted exchanges for crypto trading, FTX, filed for bankruptcy. Old-school financiers look askance at inexperienced crypto investors who they say should have known better. This year, there are new signs of a catastrophic decline in speculative investments in general. And this is part of a general trend that goes far beyond Bitcoin and other cryptocurrencies. A lot of so-called investments, like house prices and tech company valuations, look completely overvalued. That goes for so-called fintech innovations, including cryptocurrency, as well. These risk assets recently seem to be shooting for the moon. But they are now coming back down to earth. Many investors are getting burned as soaring speculative investments crater. Not just that, many people are saying that this trend will actually benefit the economy. Recent years of speculative investments have encouraged get-rich-quick speculation. Rising interest rates mean a return to the old-fashioned kind of investments. Real-world investments that use money and workers more efficiently to create real economic value. But on the other hand, the recent Bitcoin crash does not mean that the financial innovation of cryptocurrencies is over forever. Nor is housing. Nor is new technology and companies based on it. And social media companies such as Twitter. Meta's metaverse, while polarizing, is not innately bad or useless. But rising interest rates makes money tight. Many so-called investments that seem to be obvious winners are crashing. That is usually because the business model simply does not justify that optimism. A rising tide lifts all boats, to quote a familiar business saying. Only when the tide goes out do you know who's been swimming naked, said Warren Buffett, a longtime advocate of slow growth. But as central bankers raise interest rates, it is not just reckless speculators and mismanaged businesses that are suffering, said Lisa Forbes, a manager at Seed Winnipeg. Seed Winnipeg is a nonprofit that teaches and promotes business skills. It also helps to find loans for new entrepreneurs. Forbes thinks that rising interest rates are already hurting. These days, self-financing entrepreneurs are reluctant to leave safe jobs to start a riskier venture. The incredibly fast increase in interest rates is making it so that we've got people that are shy about wanting to get a loan, Forbes said. A business that never starts or is undercapitalized is ultimately unsuccessful. In the past decade, venture capital backers have preferred software as a service, SaaS, startups. But, the spate of high-profile business failures has some venture capitalists backing away. Central bankers tend to focus on whether the economy is using its financial and human resources efficiently. Many economists have warned that low interest rates would create zombie companies and serve to prevent the self-renewing process of creative destruction. Cheap money can fuel entrepreneurialism. But some economists are saying that the cost of borrowing had recently become too low. This is especially true when interest rates are below the rate of inflation. In that type of situation, investors are able to make money doing things that added little value to the economy. But there is always extra cash sloshing around the globe looking to be put to productive use. This is especially true when the banking system in certain countries cannot be trusted. Then, the money comes to bid up the value of speculative assets. Or, more to the point, assets that would not be speculative at a lower price, but are speculative at a high price. That seems to be what has happened to the price of houses in the United States. After years of astronomical growth, home prices are now declining in most markets across the United States. But housing prices are still higher than they were at this time last year. Some experts expect a steeper downturn. Other experts say it is unlikely they will fall too steeply. The US is teetering on the brink of recession. That inflation continues to rage. And the Federal Reserve is aggressively raising interest rates to fight inflation. The pronounced rise in mortgage rates over the past several months has basically made housing more expensive for buyers who need a mortgage. As a result, many buyers are pulling back. Sellers are mixed, with some sellers eagerly and systematically lowering their asking price. Still, demand seems to be somewhat strong, and that is supporting prices. There is a sharp turnaround the once red-hot, pandemic-driven housing boom. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.